For most of human history, money was something you could touch. Gold, silver, or metal stamped by kings. But today, more than 90% of all money in the world doesn't exist in any physical form. It's not printed. It's not minted. It's created from nothing. Every time you take a loan, buy a car, or swipe your credit card, new money is born, not by governments, but by banks. This idea sounds impossible, even absurd, because how can something that doesn't exist control everything that does? Yet that's exactly how the modern financial world operates. It's a system built not on gold or silver, but on trust and debt. A system so powerful and invisible that it dictates who thrives, who fails, and how the global economy breathes. The question isn't where money goes. The question is where it comes from. The myth of the printing press. When people imagine money creation, they picture giant printing machines churning out dollar bills, but that's not how the system works anymore. Today, governments print only a small fraction of the world's money. Coins, notes, and physical cash. The rest, more than 90%, exists only as digits on a bank's computer. When you go to a bank and borrow $10,000, that money doesn't come from someone else's savings. It's not taken from a vault or a pile of cash waiting somewhere. It's created instantly as a digital entry in your account. In that moment, the bank has performed something extraordinary. It has created money out of debt. This process is called fractional reserve banking. A bank is required to keep only a small fraction, sometimes just a few percent, of its deposits as actual cash. The rest can be lent out, multiplied, and relent again. Every loan creates new money. Every repayment destroys it. In this strange circular world, money doesn't flow. It expands and contracts like a living organism. The central banks, like the Federal Reserve, don't control the entire supply directly. They merely set the tone, the interest rates that determine how much commercial banks can safely lend. In a sense, the central bank writes the rhythm, but the commercial banks play the melody. And every time that melody speeds up, every time lending grows faster than production, the system swells until one day it doesn't. Money is no longer printed. It's imagined and believed into existence. The loop of debt. Every dollar in existence has a story, and it always begins the same way, with debt. When a bank lends you money, it creates that money out of nothing, but it expects you to return something real, your labor, your time, your income. So while money is created in seconds, it takes years, sometimes decades, to destroy it through repayment. This creates a loop, an invisible cycle that keeps the modern world spinning. The government borrows from central banks to fund spending. Commercial banks lend to businesses and families. Those borrowers spend their new money on goods and services, and that spending, ironically, becomes the income others need to repay their own debts. In this cycle, debt is not a flaw. It's the foundation of the entire economy. Every paycheck, every mortgage, every government bond, all of it depends on someone else borrowing tomorrow. The system cannot pause. It cannot shrink, because the moment borrowing stops, money stops being created. And if money stops being created, the economy collapses. That's why even in crisis, governments always encourage lending, spending, and credit, because they know what happens when confidence fades. The Great Depression of the 1930s wasn't just a market crash. No, it was a credit crash. Banks stopped lending. Money stopped circulating. And within months, the economy froze. So to keep the system alive, debt must keep growing, even faster than production, even faster than wages, because without debt, there is no money. We live inside a loop we can't escape, where growth depends not on what we produce, but on what we owe. The invisible hand of control. If money is born from debt, then whoever controls debt controls the world. In theory, central banks are guardians of stability, neutral institutions meant to protect economies from chaos. But in practice, most of the world's money is created not by governments, but by private commercial banks. Every loan they approve expands the money supply. Every loan they reject contracts it. That means a handful of institutions, invisible to most people, have the power to decide who prospers and who falls behind. When credit flows freely, markets boom, jobs multiply, and nations thrive. But when banks tighten lending, whether out of fear, greed, or design, entire economies grind to a halt. Recessions, unemployment, and even political instability follow in the wake of vanishing credit. Yet behind every downturn lies the same hidden lever: money creation. It's not politicians pulling it. It's not parliaments or presidents. It's the private banking network, the quiet architects of credit, who control when money expands and when it disappears, and through the simple act of lending with interest, they ensure that more money is always owed than exists. Imagine a game of musical chairs, but there are fewer chairs than players. Someone must always lose. This imbalance creates a permanent hierarchy where debt fuels wealth at the top and dependency below, because every dollar borrowed carries interest, and that interest flows upward from workers and businesses to the balance sheets of those who issue the loans. This isn't a conspiracy. It's designed a self-reinforcing loop where debt begets profit and profit demands more debt. And the deeper a nation sinks into this system, the harder it becomes to escape. That's the invisible hand of control, not a person, not a group, but a system that rewards those who keep the world indebted. Modern consequences. In 2008, the world learned what happens when credit, the lifeblood of the system, suddenly stops flowing. When banks froze lending, the illusion cracked. Stocks crashed, businesses closed, and within weeks, millions lost their jobs. The governments of the world faced a terrifying question. How do you rescue an economy built on debt when no one wants to borrow? Their answer was simple and dangerous. Create money directly. Central banks began printing trillions, not physical bills, but digital credits injected straight into financial markets. They called it quantitative easing, but to the public, it looked like magic. Markets rose, companies recovered, and the system lived to fight another day. Yet every cure left a scar, because instead of fixing the disease, they fed it. Every bailout made the system more dependent on cheap money. Every rescue taught markets that failure was no longer possible. By 2020, when the pandemic hit, the response was automatic. Print, spend, inflate. Money poured into the system like never before. But when you create too much money, chasing too few goods, prices rise, trust falls, and currencies weaken. The result? Inflation became the silent tax no one voted for. The cost of living surged. Real wages stagnated. Debt levels exploded. The very system that promised stability began shaking under its own weight. Nations now borrow money just to pay interest on older debt. Governments depend on constant growth to avoid collapse. And ordinary people, the ones who never created the crisis, carry the burden through higher prices, taxes, and endless uncertainty. The truth is, this isn't a bug in the system. It is the system, a design where growth depends on debt, and debt depends on belief. The moment belief fades, the money disappears. The money illusion. Money has always been a story we agreed to believe. Once it was told through gold and silver, then through paper and promises. Now, it exists as numbers glowing on screens, a language spoken by banks, translated into our daily lives. But what makes it real isn't metal or ink or even data. It's trust. The belief that when you trade your time, your work, your energy, someone else will return something of equal value. That trust is the foundation of civilization itself, and it's also the most fragile. When belief in money fades, empires crumble. Rome debased its silver, Weimar printed its paper, and in both cases, the story ended the same way: in inflation, collapse, and the rewriting of what money meant. Our modern world isn't immune. It runs on faith in banks, in governments, in invisible promises written in code, and if that faith ever falters, the digits will vanish just as quickly as they appeared. Money was never the treasure, belief was, and as long as we believe, the illusion continues.